Welcome to this explainer. I am absolutely thrilled to have you here today because we're tackling what is frankly one of the most persistent and dangerous illusions in the financial world. If you've ever looked at a trading strategy's historical backtest and thought it looked like a literal money machine, well, you are definitely not alone. But here's the core problem we're unpacking today. Standard trading backtests often create a dangerous illusion of perfect success. They look backward, optimized for what already happened, and present this flawless track record that almost never survives contact with the real, live market. So today, we're breaking down the Apex Execution's validation gauntlet to see exactly how institutional-grade logic strips away that illusion to find what actually works.
So why do most trading backtests lie to us? The short answer is human nature combined with mathematical loopholes. You see, historical backtesting is heavily plagued by two massive issues: path dependency and curve fitting. Path dependency means a strategy only looks good because of the exact, specific sequence of events that played out in the past. Curve fitting is even worse, honestly. It's tweaking the parameters of your strategy over and over again until it perfectly matches historical data. The result? You get a backtest that looks like a masterpiece but is actually completely useless for tomorrow's unknown market conditions.
Okay, let's dive into this. Section 1. The Lie of the Backtest.
When researchers build trading models, they run countless trial variations. They'll change a moving average from 20 days to 21 days, maybe to 22 days, constantly hunting for the highest return. But every time they run a new trial, they're artificially inflating the perceived performance of the final model. Actually, scratch that. It's more like they're inadvertently manufacturing a mirage. This leads us to the brutal honesty of this quote directly from Apex Executions: "The Sharpe ratio lies. We correct it." For decades, the Sharpe ratio has been the absolute gold standard for measuring risk-adjusted returns. But the dirty little secret is that standard Sharpe ratios inflate with every single parameter trial run during the research phase. If you test 100 variations of a strategy, the best-looking Sharpe ratio at the end isn't a measure of skill at all. It's just the one that got luckiest in fitting the past data.
To fix this, Apex implements a really fascinating metric called PBO, or the Probability of Backtest Overfit. This metric calculates the exact mathematical probability that a shiny backtest result is just a lucky artifact of digging through parameters. To mathematically bound this luck, Apex enforces a strict rule. A strategy has to achieve a deflated Sharpe ratio, which basically penalizes for all those research trials and skewed data, of above 0.60. And crucially, the PBO must be less than 30%. If the probability of being overfit is 30% or higher, no exceptions, the strategy goes straight in the trash. And you know, that is just the beginning. Strategies are put through a brutal institutional trial by fire. This is the 6-layer validation gauntlet that Apex Executions runs every strategy through before a single real dollar is ever deployed. We're talking deflated Sharpe, walk forward, block bootstrap, CPPCV, Monte Carlo, and regime condition testing. It's specifically engineered so that absolutely no luck passes through. Let's look at exactly how these layers strip away the noise. Moving on to Section 2, Eliminating the Luck Factor.
And this brilliantly illustrates the foundation of eliminating that luck: the difference between in-sample and out-of-sample data. In walk-forward validation, the historical record is split. You optimize your strategy on the in-sample window. Then, and this is absolutely key, those parameters are frozen solid. You test them on the next entirely unseen out-of-sample period. No look-back allowed, no tweaking. Apex requires an out-of-sample consistency of 60% or higher across all these sequential windows. This produces a realistic equity curve, not some curve-fitted fantasy.
But they take it even further with CPCV, which stands for Combinatorially Purged Cross-Validation. A standard setup might test a strategy linearly, but CPCV takes the historical record and divides it into multiple folds. It evaluates every possible combination of training and test sets. And to prevent information leakage, which is just a fancy way of saying the model somehow learned from data it shouldn't have seen yet, they enforce strict embargo periods between the data chunks. Think of it like quarantining students who just took an exam so they can't whisper the answers to the next group in the hallway. This doesn't just give you a simple pass or fail number. It produces a tight, highly realistic distribution of how the strategy performs on entirely unseen data.
Which brings us to Section 3, Stress Testing Against Randomness.
Even if a strategy isn't overfit, we still have to expose path-dependent strategies. 10,000. That is the number of Monte Carlo paths run for every single strategy. Think about the massive computational intensity of that. A Monte Carlo simulation takes the actual trade sequences of the strategy and reorders them 10,000 times. So, instead of relying on a single point estimate from history, this builds empirical distributions of the Sharpe ratio, maximum drawdowns, and profit factors. It produces 90% confidence intervals on every single metric. If your strategy looks great historically but has incredibly wide confidence intervals in simulation, it gets flagged as path-dependent and it fails the test.
And right behind that, we have over 1,000 block bootstrapped resampled paths. Now, this is distinct from Monte Carlo. Block bootstrapped resampling takes chunks of the underlying price data and generates thousands of alternative, realistic price paths. Crucially, it preserves the autocorrelation structure of financial returns. That means it keeps the natural momentum and mean reversion of the market totally intact. A genuinely skilled strategy must prove it can survive all these thousands of alternative resampled scenarios, not just the one specific historical sequence we happen to live through.
Next up, Section 4, Surviving Different Market Regimes. The market is not one unified thing, and strategies simply cannot afford to just be passengers in a bull market. Now, what's really interesting about this slide is the uncompromising standard it sets. Apex slices every strategy's performance into 3 distinct regimes: bull, bear, and lateral, or sideways markets. A robust strategy cannot hide behind a massive bull run to mask terrible performance elsewhere. Strategies must show a positive expectancy across all 3 conditions. If a strategy concentrates its edge in a single regime, it's immediately flagged, demoted, or halted until it can demonstrate broader regime coverage. And to test this rigorously, you can't just do a plain random shuffle of market days. A plain shuffle destroys the way real drawdowns and market panics actually cluster together. Instead, Apex simulates 1,000 synthetic histories using regime-persistent Markov chains. I know it sounds complex, but it simply means the synthetic paths respect how trending, choppy, and volatile conditions actually transition and cluster in the real world. They overlay a percentile cone of plausible outcomes directly over the real regime history, testing if the strategy actually survives realistic clustered stress.
Once we know the strategy is robust, we have to talk about survival through optimal position sizing. First up, calculating the Kelly criterion, which derives the absolute theoretically optimal position size based on win rate and average win-loss. Second, because real-world estimation always has errors, they apply a fractional half Kelly size to reduce drawdown volatility. And finally, the ultimate safety net, per strategy and per ticker drawdown limit circuit breakers. If a strategy's equity curve breaches a threshold, the system automatically halts it, catching regime changes in real time before they do real damage.
All right, Section 5, the ultimate benchmark gate. So a strategy can survive deflated sharps, walk-forwards, and regime testing, but it still faces the final, brutal benchmark test. Does it beat doing nothing? It's a heavy question. Because the reality is, a strategy can clear every statistical gate we just talked about and still just be a levered, complicated bet on the overall market going up. Let's be honest, if you're just riding a rising tide, you don't have a trading strategy. You just have expensive market exposure. Gate 7 isolates this by contrasting alpha versus beta. Beta is your basic market exposure. Alpha is the excess return representing true trading skill. Apex backtests a plain buy and hold of the exact same ticker over the identical bars with identical costs. The strategy must produce alpha above 0. But even that isn't enough. They run a significance test on that excess return series. The alpha must be statistically real with a p-value of less than 0.05. No true statistically significant alpha? No pass. It absolutely doesn't matter how pretty the raw Sharpe ratio looked on day 1.
Section 6. Only the best survive. So, the crucial point is this. When you look at an institutional leaderboard built on these principles, you are looking at reality. There are no hand-picked results. There is absolutely zero survivorship bias. Every rank reflects out-of-sample performance that has been mercilessly validated across 6 statistical layers and multiple market regimes. If a strategy is green and live, it earned it through math, not luck.
As we wrap up this explainer, I want to leave you with one final, incredibly important question. If a trading strategy, whether it's one you built, one you bought, or one you follow, hasn't survived a statistical gauntlet like this, are you really trading on skill? Or are you just riding a lucky artifact of past data, waiting for the path to change? Understanding the depth of proper validation completely transforms how you look at the markets. Never, ever trust a backtest that hasn't been put through the fire. Thank you so much for joining me for this analysis.